Okay, let's unpack this. We spend a lot of time on this show talking about investments. And I feel like there is this Pavlovian response we all have.
Mm-hmm.
I say investing, and you immediately picture a ticker scrolling across the bottom of a TV screen, or maybe some guy in a fleece vest screaming about quarterly earnings calls.
Right. It's all very digital.
It's all very digital, very abstract. It's numbers on a
It
screen.
feels ephemeral, like it could just vanish.
Exactly. But today we are pivoting hard. We are talking about something that is arguably the complete opposite of ephemeral. We are talking about the dirt, the steel, the concrete, the physical container that the entire global economy sits inside.
And significantly the largest asset class in existence, period.
That is the headline here. We are doing a deep dive into real estate investing. And I wanted to contextualize the scale immediately because the sources, they blew my mind on this.
It's staggering when you see the numbers.
It really is.
Huh.
If you take the global equity market, every single stock in the world, and you combine it with the global bond market, real estate is still bigger.
It's bigger than both combined by total market capitalization in many estimates. It dwarfs everything. It's the elephant in the room of global finance.
So our mission today is pretty specific. We aren't here to talk about buying a home and the emotional white picket fence sense of the word.
No, we're taking the sentimentality out of it.
We are here to strip away the sentimentality and look at the mechanics of this machine. We want to understand how real estate actually functions as a profit-generating vehicle and a tool for long-term wealth preservation.
Which requires a fundamental shift in mindset. It really does. Most people interact with real estate as a consumer good. It's something you use. You live in it. You sleep in it.
It's shelter.
It's shelter. Converting that view to seeing it as an asset, or, as we'll get into, a capital stack, that's a difficult leap for a lot of people to make.
And we have a massive stack of sources to help us make that leap today.
Yeah.
We've got historical legislation that goes all the way back to the Eisenhower administration.
Which is a story in itself.
It really is. We have technical breakdowns of deal structures, and we have some fairly heavy academic papers on the societal impacts of all this, particularly housing affordability.
We're going to cover the whole life cycle. We'll look at how the game has changed from this, tycoon-only club to something that's actually accessible to the average person.
Right.
And we're going to dissect the capital stack, which is my favorite part because it's kind of the secret code. It's the key to understanding risk in any deal.
And we'll get into the strategies. We'll talk about things like BRRR, and no, that's not the temperature, it's an acronym, and how people actually force value out of a property.
Yeah, how they manufacture equity.
But before we get into the weeds, I think we need to draw a hard line in the sand. I feel like the terms real estate development and real estate investing get used interchangeably all the time, but they're totally different beasts.
Oh, they are night and day. They overlap, sure, but the skill sets are completely distinct.
So what's the core difference?
Real estate development is the act of creation. It's manufacturing. You are taking a raw material, a plot of dirt, or maybe a dilapidated warehouse, and you are physically altering it.
You're building the thing.
You're building the thing.
Right.
You're dealing with zoning boards, architects, construction crews, supply chains for lumber and steel. It's high stress, it's high operational intensity, it's a full-time, boots-on-the-ground job.
It's the making of the thing.
Right. Real estate investing, which is our focus, is about the capital allocation. It involves purchasing, owning, managing, renting, or selling the asset to generate a return.
So you don't have to swing a hammer.
You can be a wildly successful real estate investor and never touch a hammer. You don't even need to own a hard hat.
So the developer's the one sweating on the job site, dealing with a delayed concrete pour.
Yes.
The investor's the one analyzing the spreadsheet and cutting the check.
In a simplified sense, yes. The investor's primary tool isn't a bulldozer, it's strategic decision-making. It's about understanding market cycles, interest rates, tenant demographics, and risk.
Okay, that's a great distinction. So let's zoom out for a second. We mentioned the scale of the asset class, but I think the cultural attachment to real estate is just as heavy as the financial one. It's not just money, it's safety, it's home.
Absolutely, and that varies wildly depending on where you are in the world. One of the most striking data points we have, and we mentioned this earlier, comes from China.
The 70% figure.
Yes. In China, it is estimated that nearly 70% of household wealth is stored in real estate.
That is staggering. Let that sink in for a moment. 70%.
It is. If you compare that to the U.S., we're much more diversified. We have the 401k system, deep stock markets, bonds, all these other vehicles.
Right. Our pie chart has more slices.
Exactly. But in China, due to a combination of capital controls and a historically volatile equity market, real estate became the de facto piggy bank. It's the only place people really trusted to put their money for the long term.
It really highlights that tangibility factor we started with.
Huh.
If the stock market crashes, your money feels like it vanished into thin air. It's gone.
Poof.
But if the real estate market crashes, you can still walk up and touch the building. It's still there. You still own the bricks.
Exactly. It offers a psychological floor that other assets just don't have.
Yeah.
But, and this is a big but historically, accessing that asset class, especially high-value commercial stuff, was incredibly difficult.
This is the country club era of real estate you mentioned.
Right. Go back to the 1950s. If you wanted to invest in a shopping center or a large apartment complex, you basically needed to be a tycoon, a Rockefeller.
You needed a top hat and a monocle.
Pretty much. You needed massive amounts of capital up front, and maybe even more importantly, you needed the connections to even find the deal. It was a closed loop. The public was completely locked out.
And this brings us to a really surprising piece of history. I honestly did not expect to be talking about Dwight D. Eisenhower in a real estate deep dive, but here we are.
September 14th, 1960. A very, very important day for your portfolio, even if you don't know it. Eisenhower signs a legislation that creates the Real Estate Investment Trust, or what we all know as the REIT.
So let's explain this. What problem was Eisenhower actually trying to solve here? This wasn't just some random idea.
He was trying to democratize access. The argument was basically this: why should the best, most stable, income-producing assets in America only be available to the ultra-rich? He wanted a way for the average American, the school teacher, the factory worker, to own a slice of the commercial real estate market.
To get a piece of the action.
To get a piece of the action. He called it creating a nation of Main Street capitalists.
So how does a REIT mechanically work? Because
Yeah.
it's not just a company that buys buildings, right? There's a very specific and very important tax nuance here.
This is the key. This is the secret sauce. A REIT is a company that owns, operates, or finances income-producing real estate. But to qualify as a REIT, they are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividend.
In 90%. That's almost everything.
90%. In exchange for doing that, the REIT itself doesn't pay corporate income tax.
Whoa, okay.
It's a pass-through entity. So unlike buying Apple stock, where Apple pays tax on its profits and then you pay tax on your dividends, that's double taxation, the REIT skips that first layer. It makes it an incredibly efficient way to generate income for investors.
That's huge. It basically turned a skyscraper into a stock. You could buy a share of the Empire State Building, conceptually, for the price of a nice dinner.
Right.
And you'd get a check in the mail every quarter from the rent paid by all those corporate tenants.
Precisely. It merged the benefits of real estate, which is the stable rent checks, with the benefits of the stock market, which is liquidity. You can sell it in a second.
Right.
But there was a catch.
There's always a catch.
Initially, these REITs were very passive. They were allowed to own the building, but they weren't really allowed to run the building. They had to hire third-party managers for everything.
So they were just holding companies.
Huh.
Like a landlord who lives in another state.
Pretty much. Until 1986. The Tax Reform Act of 1986 was the second big revolution. It allowed REITs to actively manage and operate their own properties.
So they could get their hands dirty.
This turned them from these passive holding tanks into dynamic operating companies. They could hire their own leasing agents, their own property managers. They could have a strategy. They could actually add value.
And today, this model it's global.
It's the gold standard. Something like 40 countries have adopted the U.S. REIT model. So now you can sit in New York and buy a REIT that owns data centers in Singapore or warehouses in Berlin. The access is incredible.
Which segues perfectly into the complexity of globalization. Because while you can buy that REIT in Singapore, actually going there trying to buy a building yourself is, well, it's a nightmare.
It's the information asymmetry problem. This is a concept we're going to keep coming back to again and again today.
Okay, define that for us.
In the stock market, information is relatively symmetrical. You and I both have access to Apple's 10K report at the exact same second it's released. We're on a level playing field.
Right, it's all public.
In real estate, information is wildly asymmetrical. If you are trying to buy an office building in Tokyo and you are sitting in Chicago, you are at a massive disadvantage.
What telling you now?
You don't know the local zoning nuances. You don't know that the subway station next door is closing for repairs for 3 years. You don't know the local tenant laws. You don't know the right people.
So the local operator always wins.
Almost always. That's why, despite globalization, real estate remains a deeply, deeply local game. The sources note that information quality has improved significantly in the 21st century. We have better data, satellite imagery, all of that.
Sure.
But you can never fully eliminate the home court advantage. Someone on the ground will always know more than you do.
Okay, so that's the macro view. We've gone from Eisenhower to the global market. Now I want to bring it down to the ground level. Let's say I have the capital and I want to be a direct investor. I want to buy a building. It's not as simple as walking into a store and picking one off the shelf, is it?
No, not at all. We call this the deal life cycle, and thinking of it as a cycle is really important because it's a process with distinct phases, and each of those phases has its own unique risks.
Let's walk through phase one, sourcing, finding the deal.
This is the hunt. And I think this is where most amateurs fail immediately. They think sourcing means going on a public listing site, like a Zillow for commercial properties, and just scrolling through what's for sale.
Why is that a problem? Isn't that where the deals are?
Because by the time a good deal hits the public market, the professionals have likely already seen it and passed on it for some reason. In the institutional world, the best deals are found off-market.
Pocket listings, the secret menu.
Exactly. It's all about relationships. It's a broker you've worked with for 10 years calling you and saying, hey, the owner of that warehouse on 5th Street is thinking about retiring. He hasn't listed it yet, but if you make a clean, all-cash offer, he might bite. That is where the real money is made.
So phase one is basically networking and sleuthing.
100%.
Okay, once you find the target, you move to the next stage, underwriting and due diligence.
The homework phase. And it's forensic. You are tearing that building apart, both physically and financially, piece by piece.
Give us an example of what you're looking for. What's a classic gotcha in due diligence?
Okay, financially, you're looking at the rent roll. This is the list of all tenants, what they pay, and when their leases expire. You need to verify it. Is tenant C actually paying, or are they 6 months behind? You're also checking the operating expenses. Did the seller forget to include the bill for the roof repair they did last year?
You're a detective.
You have to be. And physically, you're looking for the nightmares. I know an investor who was buying a small apartment complex. During due diligence, they paid a plumber a few $100 to scope the main sewer line with a camera.
Never a fun job.
Never. But they found that the main cast iron line had collapsed years ago, and the previous owner had just kind of rigged it. It was a ticking time bomb. It was going to cost $50,000 to dig up the parking lot and fix it.
Ouch.
But because they found that during the due diligence period, they could go back to the seller and say, knock $50 off the price or we walk.
And if they hadn't looked?
They would have bought the building, the sewer would have backed up a week later, and they would have been out $50,000 on day one. Due diligence is about risk mitigation. You are actively looking for reasons not to buy the deal.
Okay. Assuming the sewer is fine and the numbers check out, we move to phase two, execution. This is the closing.
This is the legal and financial heavy lifting. You're signing stacks of papers, you're transferring the title, and crucially, you are funding the deal. We will talk about the funding structure, the capital stack, in a lot more detail in a minute.
And then phase three, the deal is done, you own it, now what?
Now the real work begins. Ownership and exit. We call this asset management. And this is another huge misconception. People hear the phrase passive income and think it means you do nothing.
Yeah, you just sit on the beach and check your bank account once a month.
That's a fantasy. In reality, asset management is extremely active. You are constantly trying to optimize the net operating income, or NOI.
How do you do that?
2 ways.
Yeah.
Increase revenue or decrease expenses. Maybe the lobby is dated and depressing, so you spend $100,000 renovating it to justify raising rents by $200 a unit across the building. That's increasing revenue.
Okay.
Or maybe you realize the heating system is 40 years old and incredibly inefficient. You replace it with a modern system to lower your monthly utility bills. That's decreasing expenses. You are actively manufacturing value.
And eventually you sell.
Disposition, the exit. Hopefully you sell for a healthy profit. Pay off your investors, take your cut, and then usually you roll that money into a bigger deal, and the cycle starts all over again.
I love that framework. It makes it feel like a real business, not a gamble. But there is one variable in that cycle that drives me crazy, and it drives all the stock market people crazy too: valuation.
Ah, yes. The age-old question of what is it worth?
Right. If I ask you what a share of Microsoft is worth, you can pull up your phone and tell me down to the penny right now. It's instant. It's liquid.
It's a single, undisputed number.
But if I ask you what that office building across the street is worth, the answer is It depends.
It depends on a dozen factors and who you ask. This is because real estate markets are highly inefficient. No two buildings are perfectly interchangeable.
Uniqueness.
Uniqueness, and most importantly, location. You can have two absolutely identical buildings, same bricks, same architect, same everything, but they'll have vastly different values if one is next to a brand new subway station and the other is next to a noisy highway. You can't move the building.
So how do the pros do it? If there is no ticker symbol, how do we agree on a price?
There are three main methods, and depending on who you are, an investor, an insurer, a home buyer, you'll lean on different ones. But the first, and the absolute Bible for investors, is the Inky approach.
Okay, let's drill down on this. This is where the math comes in. I want to go slow here.
It's simple algebra, but it's incredibly powerful. The core metric is NOI, net operating income.
Right, you mentioned it before.
NOI is your gross rental revenue minus all your operating expenses. That's taxes, insurance, maintenance, property management fees, utilities, everything. What it does not include is your mortgage payment. That's a financing cost, not an operating cost.
Okay, so it's the pure profit the building itself generates, before any debt.
Exactly. Let's say your building generates $50,000 a year in NOI.
Okay, I have my NOI. Now what?
Now you need the cap rate, or capitalization rate. This is the number that confuses everyone, but it's the most important number in commercial real estate.
Break it down for me.
Think of the cap rate as a measure of market sentiment and risk. It is the annual return you would expect to get if you bought the building with all cash.
So if a building costs $1 million and it generates $50,000 in NOI, that's a 5% return. So it's a 5 cap property.
You got it. Now, here is the magic, or the madness, depending on your perspective. The market determines the cap rate. Investors collectively decide what an acceptable return is for a certain type of property in a certain location.
So it's supply and demand for deals.
Precisely. If everyone wants to own apartment buildings in New York City because they are seen as safe, investors might be willing to accept a very low return, say a 4% cap rate. But if you are buying a sketchy strip mall in a dying town, that's risky. You'd demand a much higher return, maybe a 10% cap rate.
Okay, so the formula is NOI divided by cap rate equals the property value.
That's the holy grail formula right there. Now let's play with that $50,000 NOI we talked about. In a safe, hot market where investors will accept a 5% cap rate, that building is worth $1 million. 50,000 divided by 0.05.
Right, makes sense.
But what happens if the market turns? Let's say interest rates spike, a big employer leaves town, and investors suddenly perceive that area as much riskier. Now, they demand a 10% cap rate to invest there.
Okay, so then it's $50,000 divided by 0.10, which is $500,000.
Exactly. You just lost half your value.
Whoa.
Your building is generating the exact same amount of cash, $50,000, but it is worth half as much simply because the perception of risk in the market changed. That is why professional investors obsess over cap rates.
That is wild. So you could be doing a great job as an owner, but your net worth gets cut in half because of something completely out of your control.
Welcome to real estate economics. It's a powerful force.
Okay, what about the other methods, the cost approach? Would you use that?
This is more for insurance purposes or for unique properties that don't generate income, like a school or a church or a government building. It asks a simple question. What would it cost to build this brand new today?
Replacement cost.
Yes. If you are buying a 100-year-old historic church, there aren't many comps for that. So you calculate the cost of the land plus the cost of the bricks and labor and materials to build it today, and then you subtract depreciation for the age and wear and tear. It sets a ceiling. No rational buyer will pay $5 million for an old building they could build themselves from scratch for $3 million.
And the third one is the one we all know from buying houses, the comparison approach.
Comps. You just look at what the nearly identical house next door sold for 3 months ago. Simple enough for houses, but for commercial properties, professionals take this a step further with something called hedonic regression.
That sounds incredibly fancy and complicated.
It sounds like something from a sci-fi novel, but it's just statistics. It's a way of isolating all the different variables that make up a property's value.
What do you mean?
Well, if you just look at two buildings and one sold for more than the other, you don't really know why. Was it the extra floor, the better view, the new roof? The fact that it's 100 feet closer to the train station?
Right. Too many moving parts.
Hedonic regression runs the sales data on thousands of properties to assign a specific dollar value to each individual feature. It can tell you, in this specific zip code, a swimming pool adds exactly $12,500 to the value, or each square foot is worth $200, Or being on a corner lot adds $5,000.
So it removes the guesswork. You can build a price from the bottom up, feature by feature.
Exactly. It's an attempt to standardize that information asymmetry we talked about. It's how big data is trying to make an inefficient market more efficient.
Okay, so we've found the deal, we've done the diligence, and we've valued it at a 5 cap.
Yeah.
Now comes the part that I think is the most sophisticated and maybe the most intimidating part of the industry. The outline uses this visual of the capital stack. I want to stay here for a bit because I think understanding this concept fundamentally changes how you see every single building in your city.
I agree. Imagine a layer cake or a stack of pancakes. This stack represents all the different sources of money being used to buy the property, but the layers aren't equal. They have different priorities, different risks, and different rewards.
Let's start at the bottom, the foundation of the cake.
The bottom layer, the biggest and most stable layer, is senior debt. This is the boring stuff. This is the first mortgage you get from a big conservative institution like a bank or an insurance company.
Why is it at the bottom?
Because it is the foundation, and because it has the first claim on the asset. If the project goes bust and the property is sold in a foreclosure auction, the senior debt lender gets paid back every single penny of their loan before anyone else sees a dime.
They're first in line.
First in line, always. Because they are the safest, they are collateralized by the physical building. They charge the lowest interest rate. In our notes, this is typically in the 3% to 8% range.
So low risk, low return. They are the bedrock. Okay, who sits on top of the bank?
Now we enter what we call the messy middle. Sitting on top of the senior debt is mezzanine debt.
Mezzanine, like the balcony level in a theater. It's in between.
Exactly. It bridges the gap. Let's use an example. Say a building costs $10 million. The bank will only lend you 60% of that, so they give you $6 million in senior debt. But you only have $1 million in cash to put in yourself. You're making $3 million.
You have a gap in your stack.
You have a gap. So you go to a mezzanine lender to borrow that missing $3 million.
What's their deal? What makes them different from the bank?
They are taking way more risk. Think about it. If the building is sold at a loss for, say, $5 million, the bank gets their $5 million and the mezzanine lender gets completely wiped out. They get nothing. Because of that higher risk, they charge way more interest, maybe 8% to 15%.
Do they have any security at all?
Usually, their security isn't the property itself, it's the ownership structure of the property.
Yeah.
If you default on the mezzanine loan, they can sometimes foreclose on your equity interest in the LLC that owns the building.
So they can kick you out.
They can kick you out and take over the project without having to go through a messy 2-year court battle with the big bank. It's fast and brutal.
High stakes poker. Okay, and sometimes mixed in there is something called preferred equity.
Right. Preferred equity is a hybrid. It acts like a loan because it gets a fixed or preferred return, say 10%, but it's legally considered equity. They get paid after all the debt, but before the regular owners get anything.
So they have preference.
They have preference. They get to eat before you do. They don't usually have foreclosure rights like debt does, but they might have rights to take control of the project if you miss their payments.
Which brings us to the very top of the stack.
Yeah.
The cherry on the cake. Common equity.
This is you, the sponsor. The investor, the person who put the whole deal together.
Why would anyone want to be in this position? You're last in line. You only get paid after the bank, the mezzanine guy, and the preferred equity guy all take their cut. Your money is the first to get lost if things go wrong.
It's the position of highest risk, yes. But it is also the position of infinite upside.
Explain that. What do you mean infinite?
The bank only ever gets their 5% interest. Even if the building doubles in value and you make a massive profit, the bank still just gets their 5%. The mezzanine lender just gets their 12%. Their return is capped.
Okay.
But you, the common equity holder, you are the residual claimant. Once everyone else has paid their fixed amount, every single remaining dollar of profit belongs to you.
So if the deal's a home run, the common equity makes all the profit.
All of it. The returns for common equity in a successful deal can be 15%, 20%, 50%, even technically infinite if you refinance all your original cash out of the deal. That is the trade-off. You take the first loss risk. If the value drops, your money is wiped out first.
Yeah.
But in exchange, you get the unlimited upside.
This is really the pure definition of leverage.
Yes. Using OPM other people's money. Let's go back to that $10 million building. Let's say I buy it with $2 million of my own money, common equity, and $8 million of debt. Now, let's say the building goes up just 10% in value over the first year.
So the building is now worth $11 million.
Right. The building went up by $1 million in value, but I only put in $2 million of my own cash. So my equity went from $2 million to $3 million. That's a 50% return on my money from a simple 10% move in the underlying asset.
That is the magic of leverage. It magnifies your returns.
And the danger, because if the value goes down 10%,
Your $10 million building is now worth $9 million. You still owe $8 million. Your $2 million of equity is now only $1 million. You lost 50% of your money.
or all of it, if you are over-leveraged. This is why banks have LTV or loan-to-value limits. They want you to have skin in the game.
Typically 20–30% of the value.
Exactly. They want to know that if the value drops, it burns through your money before it even gets close to touching their money.
What about when the building is a total disaster? I'm thinking a boarded-up property with no roof. A traditional bank isn't going to lend on that, right?
No chance. That's when you need hard money or bridge loans. These are the aggressive short-term lenders. They will lend on the as-repaired value, or ARV. They'll lend you money based on what the property will be worth after you fix it up.
But I'm guessing it's expensive.
Extremely. They might charge you 10, 12, 14% interest plus huge upfront fees. It's a sprint, not a marathon.
That's a bridge to get you to stability.
Exactly. You use that expensive money to fix the roof, put in new kitchens, and get tenants in. Once the property's stabilized and generating income, you run to a regular bank and get a nice, cheap 5% long-term loan to pay off the expensive hard money guy.
But while you're doing all that work, you have the carry cost. This sounds ominous.
It's the silent killer of deals. While you are fixing that roof for 6 months, there is no rent coming in. But you still have to pay the insurance, the property taxes, and that very expensive hard money interest payment every single month. That is negative cash flow.
You are feeding the beast every month out of your own pocket.
And if you run out of cash before you finish the renovation and get a tenant in, the beast eats you. That is how most beginner developers and investors go bankrupt. They underestimate the carry cost.
This folds perfectly into the next segment. We've talked about how to lose money through things like carry costs. Let's talk about how to make money. The sources outline 4 distinct profit centers in real estate. And I think most people only ever focus on one of them.
Right. Most people, when they think of real estate profit, they focus on cash flow, the check you get every month. But sophisticated investors look at the 4 sources of return.
Number 1 is that NOI cash flow.
Simple enough. Rent comes in, expenses go out, what's left over is your profit. This is the money you can spend on groceries.
Okay, number 2 is where it gets really interesting, especially from a tax perspective. Tax shelter offsets.
This is arguably the most powerful tool in the entire kit. The U.S. tax code absolutely loves real estate investors.
And the magic word here is depreciation.
Yes. The IRS allows you to assume that your building is wearing out over a period of 27.5 years for residential property. So every single year, you get to take a paper loss on your taxes that's roughly equal to 3.6% of the building's value, not including the land.
But you didn't actually lose that money. You didn't write a check to anyone for depreciation.
Exactly. It's a phantom expense.
Mm-hmm.
So let's say you make $10,000 in actual cash profit from rent this year. But on your tax return, you also show a $10,000 depreciation expense. Your taxable income is now 0. You get to keep the $10,000 in cash, but you pay no income tax on it.
That feels like a cheat code. It really does.
It feels that way. And if you have carryover losses from depreciation, you can sometimes use those paper losses to offset income from other sources, like your day job. It's why you often see headlines about billionaire developers paying very little in personal income tax. They aren't evading it. They are legally using depreciation.
Okay, that's a huge one. Number 3 on the list.
Yeah.
Equity buildup.
I like to call this the forced savings account. This is just simple loan amortization. Every month, your tenant pays you rent. You take a portion of that rent and pay the bank your mortgage. A part of that payment goes to interest, but another part pays down the principal of the loan.
So even if the property value stays completely flat and you break even on cash flow every month, you are still getting richer because your debt is shrinking.
The tenant is buying the house for you, one mortgage payment at a time. It's a beautiful thing.
And finally, number 4, the one everyone hopes for and talks about, capital appreciation.
The value of the asset going up over time due to inflation, market demand, or improvements you've made.
But there is a huge warning label here in our notes about this one.
A massive one. If you buy a property that loses money every single month, it has negative cash flow. Just because you think it will be worth more in 10 years, you are not investing. You are speculating.
Gambling on appreciation.
And that's a dangerous game, because if the market turns, or if appreciation doesn't happen as fast as you hoped, you are left holding a bag that is costing you money every month. Smart investors view appreciation as the icing on the cake, not the cake itself. The cake has to be the cash flow.
Okay, so we have the for-profit centers. Let's talk about the specific strategies people use to capture them. We teased this in the intro. BRRR.
The sound of cold cash.
It stands for buy, rehab, rent, refinance, repeat. Let's walk through a hypothetical deal to show why this strategy is so popular with investors.
Okay, let's do it. Step 1, buy. You find a beat-up, ugly house. It's listed for $100,000. You buy it with cash, or more likely with one of those expensive hard money loans we talked about.
I get it.
Step 2, rehab. You spend $50,000 fixing it up. New kitchen, new floors, fresh paint. You make it beautiful. So now you are all in for a total of $150,000.
Okay, I'm with you.
Step 3, rent. You find a great tenant who is happy to pay you $1,500 a month to live in this newly renovated home. Now the property is stabilized and generating income.
And now the magic step. Refinance.
This is the key to the whole strategy. You go to a regular bank. The bank sends an appraiser out to the property. Because you fix it up so nicely, the appraiser says, this house is no longer a $100,000 house. It's now worth $200,000.
You force the appreciation through the rehab.
Exactly. The bank agrees to give you a new long-term loan for 75% of the new appraised value. 75% of $200,000 is $150,000. They cut you a check for $150,000 to pay off your old loan.
Wait a minute. You spent $100,000 to buy it and $50,000 to fix it. That's $150,000 total. The bank just gave you a check for $150,000.
You have now pulled all of your original capital back out of the deal. You still own the house, you have a tenant paying the new mortgage for you, and you have $0 of your own money left in the deal. Your cash-on-cash return is technically infinite.
And the final R, repeat.
You take that $150,000 tax-free check, because it's loan proceeds, not income, and you go find another ugly house and do it all over again. That is how people can build massive rental portfolios starting with relatively little cash. It's all about the velocity of money reusing the same capital over and over.
But it relies on everything going perfectly. You have to find that deal where the numbers work.
Which is very hard to do. And it carries real risk. If the appraisal comes in low or if interest rates spike in the middle of your project, you can get stuck holding that expensive hard money loan and get wiped out by the carry costs.
And another strategy mentioned in the sources is foreclosure investing. This feels a little grittier.
It is. This is investing in distressed situations. You have a few different entry points here. You can try to buy in pre-foreclosure. This is where you find a homeowner who has received a notice of default, but the bank hasn't sold the house yet. You might knock on their door and try to buy it directly from them before the bank takes it.
Then there's the auction itself.
The sheriff's sale on the courthouse steps. This is the Wild West of real estate. You usually have to pay with a certified check right there on the spot, and sometimes you're buying it without ever having been inside the house.
You could be buying a house that has been completely gutted by angry former owners.
Or a house that has a massive IRS lien on it that you didn't know about. It's extremely high risk, high reward. If the property doesn't sell at the auction, it becomes an REO real estate owned. The bank now officially owns it.
And banks are terrible landlords. They don't want to own property.
They hate it. They are in the money business, not the toilet fixing business. So REOs can often be good opportunities because the bank is a motivated seller. They just want to get the non-performing asset off their balance sheet, often at a discount.
And for those of us who don't want to deal with courthouse steps or angry contractors, there is a much more modern approach, crowdfunding.
Yes, the 21st century model. This really exploded after the JOBS Act was signed in 2012. Before that, you couldn't really advertise private investment deals to the general public. The JOBS Act changed the rules and allowed for what's called general solicitation.
Enter companies like Fundrise.
Exactly. The sources mention Fundrise as the pioneer in the U.S. They allow for pooling of capital. You can put in $5,000, I can put in $5,000, and we can pool our money with 10,000 other small investors online to go buy that $50 million apartment complex that we could never afford on our own.
It democratizes the capital stack.
Right.
It lets the little guy finally sit in the common equity seat of a really big institutional quality deal.
It does. It removes the operational headache, which is great. But the trade-off is that it also removes your control. You can't decide to renovate the lobby or fire the property manager. The fund manager at the crowdfunding company makes all those decisions.
We've spent a lot of time talking about the mechanics of profit, the nuts and bolts. But I want to pivot now to the final segment of our outline, which I think is arguably the most important. We have to talk about the consequences of all this.
So what?
When we talk about BRRR or cap rates or forced appreciation, we are fundamentally treating housing as a financial product, as an asset to be optimized.
The academic term for it is the financialization of housing.
Right. But housing isn't just a stock ticker. It's a fundamental human need. And the sources point out that there is a growing and very real tension between real estate as an asset and real estate as a home.
That tension is acute right now, all over the world. When you have institutional capital, I'm talking about large pension funds, private equity firms, entering the single-family rental market at scale, the dynamics of that market change completely.
There's a case study from Ireland in our notes that was really striking.
Yeah, this was a fascinating and pretty sobering study. The researchers looked at the influx of global institutional investors into the Dublin rental market after their housing crash, and they found a direct statistical correlation between this financialization and a rise in homelessness.
How do they connect those dots? What's the mechanism?
It's about pricing power and incentives. Institutional investors have a fiduciary duty to their shareholders to maximize returns, to maximize that NOI. So they are very aggressive about raising rents to market rates. They are aggressive about repositioning assets, which is a polite term that often means evicting lower-income tenants to do a high-end renovation and bring in higher-income tenants.
Gentrification on steroids, basically.
Exactly. And indirectly, these large funds have massive lobbying power. The sources show they can influence state and local policy to favor the build-to-rent model over policies that support affordable homeownership initiatives.
It creates this fundamental conflict of interest at a societal level. The homeowner, or the investor, actively wants prices to go up. It makes them rich. It's the core of their strategy.
Right. Appreciation is good for them.
But the person trying to buy their first home, or the renter struggling to make ends meet, needs prices to stay flat or even go down.
One person's asset appreciation is another person's housing crisis. You simply cannot have both at the same time.
And the sources mention this gets even more cynical with things like immigration lobbying.
This is a macro strategy. Some large-scale real estate lobbies actively push for higher immigration levels, not necessarily for humanitarian reasons, but because population growth is the primary driver of housing demand. More people competing for the same number of units equals lower vacancy rates, which equals higher rents.
It's treating population dynamics purely as a demand curve for a product. It's stripping all the humanity out of it.
It is. And this leads directly to the political backlash we are seeing globally. When housing becomes fundamentally unaffordable for the working and middle classes, public sentiment shifts. We see research that suggests high housing costs directly increase public support for policies like wealth redistribution.
People start to feel like the social contract is broken. If I work a full-time job but still can't afford a decent roof over my head, the system must be rigged against me.
Exactly. And that is a real risk for the investor, too. If you push the profit lever too hard for too long, eventually the regulatory hammer comes down. Things like rent control, vacancy taxes, even outright bans on corporate ownership of single-family homes. We are starting to see these policies being floated and even enacted in cities like Berlin and Amsterdam.
So real estate is this incredible double-edged sword. It's arguably the greatest wealth builder in history. It allows a regular person to leverage $20,000 into a $1 million asset portfolio using a strategy like the BRRR method. But at the macro level, if everyone starts treating homes purely as capital stacks, we risk breaking the housing market for the next generation.
That is the defining tension of our time in this entire asset class. How do we balance those two things?
This has been a massive deep dive. We've covered a lot of ground here. Let's just quickly recap the journey before we close out.
We started with the sheer scale of it all, real estate as the quiet giant of the global economy. We looked at the history from the old boys club of the 1950s to Eisenhower's REIT revolution that really let the rest of us in on the game.
We broke down the deal life cycle, the hustle of sourcing, the paranoia of due diligence, and the long, active grind of asset management.
We did the math on valuation and hopefully demystified the cap rate, showing that value is really just NOI divided by the market's collective mood.
We visualized the capital stack, that layer cake of risk and reward, where the bank takes the safe, boring bottom layer, and the investor takes the risky, but potentially hugely profitable top.
And we looked at the strategies, BRRR, foreclosures, crowdfunding, and finally, we had to confront the heavy societal cost of turning our homes into financial derivatives.
It's a lot to process, but I hope, if nothing else, it changes the way you look at your own city.
It usually does. You stop seeing buildings and you start seeing deal structures and spreadsheets.
And that leads me directly to my final thought for you, the listener. We talked a lot today about information asymmetry. That core idea that in every real estate transaction, one person almost always knows something the other doesn't.
The pro versus the amateur.
Next time you walk into an apartment viewing, or you look at a house for sale, ask yourself, who is on the other side of this deal? Are they seeing a home with a nice kitchen and a big backyard? Or are they seeing a capital stack with a 5% cap rate, a clear path to force appreciation, and a 3-year exit strategy?
Because if you don't know the game they're playing, you are almost certainly losing it.
Exactly. When you look at that building, are you seeing shelter or are you seeing a spreadsheet? Thanks for diving deep with us. We'll see you on the next one.